Hi traders, welcome to my free Forex trading course. The Forex markets provide some of the biggest opportunities for us as traders. It is the biggest market in the world by far. To this day, $6.6 trillion exchange hands every day in the Forex market. Compare that to the New York Stock Exchange, where only $22.4 billion exchange hands. However, to take advantage of this big opportunity, we have to understand how the Forex market works, the best strategies for it, since it's different than other markets. It's open 24 hours, 5 days a week, and there are two sessions that are very active as opposed to other markets like the bond market or the stock market. I was going to do a brief introduction of myself. My name is Carlos Partida. I am an engineer who became a trader by accident. I was collaborating with a private hedge fund, doing the IT stuff for them, fixing the computers, installing servers, and stuff like that. And I developed friendship with the manager, and he is the one who encouraged me to move from IT into the financial markets. And I've been a trader and investor for about 15 years. I participated in many events in the speaking Spanish community. I've been in magazines. You can see my analysis in the most important websites like Rankia, investing.com, and FX Street. This is my first channel for the English speaking community since my English is getting a little rusty and I like to practice my English. So if you can see past my accent, you will learn a lot of cool stuff. What is foreign exchange? We will cover some of the basics and then we will get to the most important stuff. But you will see why even the basics, it's important to review. Foreign exchange market stands for, Forex stands for foreign exchange, which means exchanging currency. We all have done that probably when we travel and have to exchange one currency or the currency in our country for the currency in the country we are visiting. The currency exchange business makes money by the difference between the bid and the ask, or the price at which they sell and they buy. And that is called the spread. That is basically what we do in the Forex market. Now, we have to view who are the main participants of this market. This is very, very important, and we will see later on why it is vital for our success to understand this. Commercial banks are at the top of the food chain in the Forex exchange market. It is their business. It is very important to understand that, guys. They make billions of dollars every quarter. You can go and look it up on the internet. It's public information. Banks like Deutsche Bank, JP Morgan, Goldman Sachs, Morgan Stanley. It is their business, and we have to understand that this is a zero-sum game, which means for every dollar somebody makes, somebody else have to lose a dollar. So that means all those millions and billions of dollars these companies are doing or are making through the exchange market, through the Forex exchange market, it is because smaller participants like us, retail traders, are losing money. Central banks participate in this market as well. Sovereign wealth funds, hedge funds, pension funds, private brokers, proprietary trading firms, money transfer companies, and at the bottom of the food chain, it's us, retail traders. This is very important to understand. So we have to be very careful how we trade. We have to have a solid game plan and be very disciplined in applying the rules if we are to succeed in this market. As far as we are concerned, there are two main participants, guys, in these markets. Okay? The herd of traders and the smart man. That's why we have to be very careful with what we do. Let's cover a little bit more of the basics and then let's get to the charts. When trading Forex, you are always buying one currency and selling another currency, like when you travel. Okay, these are called Forex pairs. This is the Forex pair. This is the main one, the one that has the most liquidity, euro, US dollar. Every currency has three letters. It's usually the first two letters is the country and the last letter is the currency. In this case, United States dollar stands for USD, euro is the euro and Europe, Australian dollar is A and U stands for Australia and D for dollar. In the case of the British pound, G and B is Great Britain and P is the pound. Okay. If our analysis had led us to believe that the euro is going to rise and the dollar is either going to stay sideways or fall, then we will buy the per euro US dollar. In this case, we will hit the buy button. It used to be that it only had 4 decimals, okay? And the 4th decimal was the smallest movement a forex pair could have, and that's called the pip, okay? It's a pip. When you're trading forex, you're always dealing with lots. Some brokers, the smallest lot they allow you to trade with, it's a micro lot, and that's $1,000 lot. A mini lot is a $10,000 lot, and a full lot is an $100,000 lot. We use a lot of leverage on the forex market in order to make money and being able to make enough money out of small moves. Some brokers, very regulated, like in the United States, give you a 50-to-1. Okay, that means for every dollar you have in the broker, they will lend you another $50. Some other brokers in other places with different regulations allow you 200-to-1 and some even 400 or higher to 1. We have to be careful with this because this is the easiest way to blow up your account is over leveraging. Okay, so when it moves 1 pip, what happens when you're trading a micro lot? That means you can make or lose if you're in the wrong side $0.1. If you're using a mini lot, you can make or lose $1, and when you are using a full lot of $100,000, you can make or lose $10 per pip. Okay. This is the sell price. This is the buy price for the pair, and also known as the ask and bid. And before we get to more interesting stuff, there is a risk disclaimer for forex trading that is very important. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. The high degree of leverage can work against you as well as in your favor, and before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibilities exist that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This is very important. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. The information presented in these videos is going to be for educational purposes only, guys. This is not trading advice. I cannot give you trading advice. Okay, it is against the law. In order to understand the forex market, because when you see all the forex pairs and some moving in one direction and others in a different direction, it may seem like a chaotic market, but it is not. There is an order to it, and there is a reason why some pairs move in one direction and others in a different direction. If you can understand the basics of this, you can spot for your session of trading the forex pairs that can give you the best opportunities for trading. Okay, and I'm going to simplify it for you. I'm going to give you a system that you can easily scan the forex pairs and find the ones that can give you the best opportunities for the session you are trading. The forex pairs called the majors are the ones that have the most of the liquidity, highest volume, and it is easier to get in and out of those forex pairs. They are formed by 8 currencies, the main one being the US dollar for obvious reason. It is the biggest economy in the world. Now, some traders have negative views about a certain country or in favor of one country, and that influence what forex pair they trade. You have to leave your political views on the side. Discuss them with your friends in a coffee chat. When you're trading, you have to be objective in order to make money. This is the biggest economy in the world, and that's the most important currency in the forex market. The other 7 currencies are currencies of developed countries that are very important. The euro, okay, all the eurozone uses the euro and is the second most important currency in the forex market. And then you have the British pound, Australian dollar, New Zealand dollar, although this has the smallest volume among the 7 currencies. You have the Japanese yen, Swiss franc, and Canadian dollar. When you combine any of these currencies with the US dollar, you get 7 currency pairs, which are called the majors. There is a reason why in future markets, which is a centralized market, you can only trade these 8 pairs, and we'll come back to it. And that's where big institutions are trading as well. What happens when you combine 2 currencies of developed countries with good economies that do not have the US dollar? Then you have what is called the crosses. Between the major and the crosses form 28 forex pairs. I trade more than 90% of the time, 95% of the time or more on these forex pairs. They give you the best opportunities, have the most liquidity, and they have the most volatility, guys. So this is the most important forex pairs to trade. Now, in order to understand why and how these 28 forex pairs move, let's go back to the basics. When you are trading cross, let's say euro, British pound, what you are really doing, let's say I go long euro, British pound. What I'm really doing is going long the euro US dollar and going short the British pound US dollar. That's why in the future markets, like I said, you can only trade these 8 currencies, because if you want to go long euro and short the British pound, like you could do going long this forex pair, what you do is you buy the euro and sell the British pound. You can make your own forex pair over here. It is important to understand that, because by seeing how these 7 pairs are moving, you can kind of know how the crosses are going to move. Now, if this is a little complicated for you because it's a little bit advanced, don't worry. You can go ahead and check the moves of every single one of these. But eventually, it's going to be much faster and simpler for you to understand the correlation. So you can check these 7 pairs and know exactly what these 28 pairs, or have a very accurate idea of how these 28 forex pairs are moving. Why am I saying this? Because if you see a big move, or if I see a big move, for example, in the Japanese yen, I go and check all the crosses with the Japanese yen, because I know the move is going to be there. Now, also, if I see that the euro is going up, however, the Aussie dollar has been going down, then I can look at this cross and it's gonna have the biggest move. Okay, we'll see that in the charts in a second, guys. Okay, the other forex pairs are called exotic pairs. It's usually a main currency of a developed country and an emerging market. For example, US dollar and Turkish lira, US dollar and Russian ruble, or US dollar and Mexican peso, which had huge moves on 2022 and this 2023. These forex pairs have less liquidity. The spread is bigger, the difference between the bid and the ask, which is, by the way, the commission you are paying in the forex market. I usually only trade these forex pairs when they have big moves and for longer moves, not for scalping, not for intraday trading, unless they have an extremely good, solid opportunity. Because of the reasons I mentioned before, I concentrate on the other 28 Forex pairs. So now let's take a look at the chart. Okay, guys, this platform is MT4. MT5, it's also very popular for the Forex market, and TradingView has become a very popular platform for almost everything. It doesn't matter what platform you're using, as long as you know what you're doing and you're looking at the right things. This is a blank chart. It has nothing but the price action. And we are going to be talking about that. This is the euro US dollar. And this is the hourly chart. We go to the 50-minute chart. This is the move of the British pound. And as you can see, well, you only have the price information, the spread, because the Forex market, the cash market of the New York Stock Exchange just closed, and liquidity is drying up a little bit. Now, I'm going to add one template, which is the one I use, and I'm going to explain why it's useful to use a template. But before we get there, let's see how I have organized my platform. I have the main Forex pairs here on the left, one after another. First, I have the 4 majors, where the US dollar, by the way, the first currency, it's called the base currency. And the second currency in the pair, it's called the quoted currency. Okay, so this means the price with the euro US dollar, the price reflects how many dollars you need to buy an euro. If you have the British pound, Canadian dollar, the price reflects how many Canadian dollars you need to buy 1 British pound. So I have the main pairs here, just so I can quickly look at the main pairs. First, the ones with the US dollar is the quoted currency. Then when the US dollar is the base currency, USD Japanese yen, USD Swiss franc, USD Canadian dollar. And then I have the crosses organized with first the euro crosses, then the British pound crosses, then the Aussie crosses, then the New Zealand crosses, and then at the end the Canadian dollar and the Swiss franc cross. Okay, now we can quickly, let's go and check what's going on. For example, on this one, the US Canadian dollar had a big move and then a correction, as you can see. So if it's moving, I can quickly go US dollar. The next one for me to check would be the Euro CAD. I know it's going to be around here, Euro CAD. And then the British pound Canadian dollar, and I know what it is, okay? And then the Aussie dollar, Canadian dollar. And then the New Zealand Canadian dollar. And then the Japanese yen, the Canadian dollar, Japanese yen. You can see it has the same move, right? That's why I have it organized this way. Now, let's look at my chart. Let's go to the RSI 1 hour. Now, these are the indicators I used. Indicators are used by 2 types of traders. Beginners who think the indicators are going to tell him or tell her when to enter into the market. They lose money, and then they end up hating indicators and they don't use them anymore. The professional traders use them to get information from the market. There are 4 types of indicators. I'm going to briefly go over them. Trend, which give you information about the trend. Oscillators, which give you information about when the trend is getting weaker. Volume, which tells you the volume that is being traded, and we talk about the volume in the Forex market. And volatility indicators. Okay, I don't use all the indicators all the time. The reason they are on the chart, it's because the computer draws them automatically, and I can have them there in case I need it. In the next video, because this one is getting too long, I'm going to show you how the institutions, the big players, use indicators, which is the way I use them to see if they are looking at something and buying or selling. But that will be in the next video. For now, if you find this video interesting, just gently hit the like button and the subscribe button so you don't miss the next video.